of economic data has been released recently for the Indian economy. Now, first up is the fiscal deficit numbers. A fiscal deficit is the difference between the total expenditure and revenue of a government. In other words, it is a shortfall in the government's income compared with its spending. Now, the central government's fiscal deficit widened to Rs 9.78 lakh crore in April to November period, accounting for about 59% of the full year target. Now, this compares to 46.2% of the last year's target. Now, the rise in fiscal deficit was led by sharp growth in capital expenditure and higher transfer to states. Now, with about 8 months of the fiscal year already completed, the fiscal deficit is about 59% of the budget's target. Now, as of right now, the centre's finances appears to be in a good shape. Now, the government's estimate of fiscal deficit for the entire fiscal year 23 is about 16.61 trillion rupees or 6.4% of the GDP. Now, given the risk posed by the global uncertainty, we do think that managing the government's expenditure side could become challenging as a result of greater subsidy expenditures. However, the centre is likely to achieve its 6.4% GDP yearly target due to this year's high rate of inflation. The nominal GDP, which serves as a numerator for the fiscal deficit ratio, is likely to be greater than the budget's estimate. Having said that, the pandemic had pushed the fiscal deficit beyond a comfortable level, and we do believe that it needs to be brought down gradually. Another indicator that has been released is the core sector output growth. Now, core sector is an index of the 8 most fundamental industrial sectors of the Indian economy. Now, these sectors have significant links with other industry and therefore have a strong impact on the Indian economy. Now, the core sector number normally has larger ramifications for the IIP and the GDP growth. The output growth of India's 8 core sectors rebounded to 5.4% in November compared with a 0.9% uptick in October. But this was on the back of a favorable base effect. In the year-ago period, in November 2021, the core sector index fell to 131.8 from 137.8 in October 2021. While coal, fertilizers, steel, cement and electricity segments continued to perform well, the recovery in these sectors was offset by a continued dip in crude oil, natural gas and refinery output. Now, so far in fiscal year 22, the core sector output has witnessed a growth of 12.4% as against the contraction of 9.8% in the corresponding period last year. The growth in core sector output has been marginally higher during the month. However, the growth numbers were slightly muted. In the near term, the economic recovery in India faces headwinds such as a looming global slowdown, quick monetary tightening, and also the continued economic impact of the Russia-Ukraine war. However, we do believe that significant capex push by the government bodes well for the core sectors in the long term. So what does these news mean for you? Managing expenditure could become challenging, but so far the government's finances seem to be in order. This will have an indirect neutral impact on you. While a normalizing base will moderate the year-over-year expansion, core sectors continue to remain muted amid global headwinds. This will have an indirect neutral impact on you. While I say this is me, Merlin Susanna signing off. Take care and stay invested.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.